What's happening, you all? We're back again for another one. You know who this is? The CoWaCo, the company water cooler. Yeah. So remember to like, subscribe, comment, and share. We're not financial advisors, but this is for education purposes only. And we about to get it in. So our first point today is why we should invest long term. Chris, what you got to say, my man?
Yes, sir. Yes, sir. Ladies and gentlemen, thank you for joining us. This is the company Water Cooler. I am Chris. That is Leroy. We appreciate you so much. We're going to start with why you should invest long term, because you want wealth down the line, and you want to, hopefully, your goal is to work less and less for somebody else and to work more and more for yourself. So only wealthy people get to do that. When you're not wealthy, you don't get to work for yourself, right? Because you're giving your time to a man or a woman who is already wealthy. And so you're helping them live out their dream. Every time I hear a complaint about Amazon, or I hear a complaint about Walmart, or I hear a complaint about any other retailer or any other store, or I hear a complaint about a company by an employee of that company, my first response and reaction is, well, what can you do to get yourself out of that situation? You can get a part-time job that you then leave your current full-time to make that your full-time. You could start your own business, which is what I always recommend, and grow that and scale that up so that you're working for yourself. But it's never Walmart's fault or Amazon's fault. Amazon was somebody's dream. Walmart was somebody's dream. When you're employed there, you're just helping them build, and it just happened to be Sam Walton and Jeffrey Bezos. You're helping these men live out their dream. You didn't have to get a job there. Nobody forced you to get a job there. Nobody came to your house and said, now you work at Amazon, go deliver parcels. Nobody said, hey, now you work at Walmart, go refill the grocery bag holder. Nobody said that. Nobody forced you to do that. So you have to take that responsibility on yourself. I am not saying that you have to love your job. A lot of people don't love their job. But if you detest it so much that you complain about it, you have to seek other forms of revenue. You got to seek other sources of revenue. You have to do that, right? So this is why we invest long term, because even someone who loves their job or appreciates their job, they want to be able to take time off and take a trip whenever they want, right? That man is not, that man doesn't feel masculine, or that man doesn't feel like a man if he has to go ask another man for a day off. Hey man, can I please get a day off? Because you don't want to do that, right? That woman doesn't want to go in the office and say, okay, well, let me demean myself a little bit and find an excuse or make up something so I get a couple of days off. No man or woman wants to do that. So I want to be able to take 2 weeks to go away, just leave. But if I'm employed by someone else, I can't do that. I have to ask for permission, right? So this is why it is a request for time off. You see what I mean? It's never a time off form. It is a request sheet. You got to put that request in, because they can do what? Deny your request, right? Now, you cannot show up to work, but then you risk losing your job. Right. And depending on where you work, that goes here and there. But all employers have a certain amount of time where, without an excuse, you can't show up and keep a job. So it might be 4 days for one company, or 2 days for another. 2 days, no show, you're fired. 4 days, no show, you're fired. It depends on company policy. But if you want to take those 2 weeks off, you have to put in that request. If you want to take a day off, you have to put in that request. Now, most employers, if you just don't show up for a day and you come in the day after that, you're gonna have to sit down and talk with management and, hey man, so you weren't here yesterday. What's cracking with that? What's where we at? What's going on? You're gonna have to explain to them, hey man, whatever. Now, depending on your employer, you might have to say something crazy, like, yo, my cat got stuck in the tree and my dog had to save it and my feet were buried in the ground and I couldn't get it. You might have to come up with something crazy like that. Or you might be able to say, hey, look, I didn't feel like showing up. And if your employer is desperate for workers, they're going to be upset, right? Your employer is going to be mad. Whoever your supervisor is going to be mad, but he'll say, okay, all right, that sets the tone for future interactions. Because he can be like, oh, okay, you didn't show up because you didn't feel like it. All right. Okay. Cool. You know what? Cool. Go ahead back on the floor. You good. Go ahead back on the floor. You fine. Don't worry about it. In the back of his mind, the next time you come for a promotion, the next time you ask for a raise, this day is in his mind. Oh, remember that day that you decided you weren't going to show up? Today, I'm deciding not to give you a raise. That's what it is. Hey, man, tough luck, right? And you'll have to build back that trust. But this is why you invest long term. So eventually, you're working for you because you're making your money work for you. You can take all the time off that you need. Your business is automated and it will run itself.
Yeah, buddy, that's what's up. That's what's up. And also, too, remember, long term, you're also looking out for your family and friends, too, that you have built a good relationship with, and like and shown a track record of they're trying to strive to, long term, for your children, if you have any, so just, think about those where whenever they get older, they won't have to, put out so much or struggle, and we've actually talked about this before, about the long-term investing before, whenever it comes to like even with your children, too. So that's what's up. All right. So
yeah, it's all for the kids. It's all for the kids. Everything we do is for the kids. Because you don't want them to have to go work at the same less than minimum wage job that you had when you were 16. You want them to have a life that you're just now experiencing at 36, 37, 42, 44, and they're 14, 15 years old, and their first car costs $300,000. Not because you want to stunt on somebody, but because you can afford it 7 times over, and it's no big deal. And they have access to things that you only dreamed of before that. So it's all for the kids.
That's what's up. There you go. All right, so our next point with the long-term investing, right? So next point is why you should not try to predict the market.
Man,
Chris, what's up?
Don't listen. Why? Do not, because what you're doing is, so tomorrow, and this won't happen, but tomorrow, every dollar made by every company in the stock market, on the S&P, in the NASDAQ, the Russell 2, all of those could go to zero. When you invest, you risk the potential of the money that you're investing going to zero, right? Again, I mean, that's never going to happen, but that is still a risk that you take. A company could be selling $100 a share today. You invest, the next day it could be at $2, right? And it's like, well, damn, what happened that it lost 98% of its value in 24 hours, right? Obviously, the signs will be extremely, like it will be glowing red if that ever is the case, but because it usually takes months, years for a company to get bad. But trying to predict the market, the most important reason why you should not try to predict the market is because you'll never get in. You'll never enter into the market because you'll want to find, I can get a better price. I promise. Okay, I'll wait. Oh no, that's okay. I'll wait. And you'll wait so long that you'll become a professional procrastinator. And it'll be 2 years, 5 years, 10 years, and you're not in the market yet because you keep waiting for the best price, or you keep waiting for the change in management, or you keep waiting for the split. Don't do that. Invest now. Steady investing, and you hear it all the time from the greatest investors. Steady investing in the market is way better than trying to predict when the price is going to be good. Predict when, what is it? Time in the market is better than timing the market. That's what the master investors say, right? That's what the greatest investors say. The master investor says that, double salute, and the greatest investors say that as well. When you're in something for 5 years and you've invested consistently throughout that 5 years, that's much better than waiting the 5th year to put everything in. Think about it like a relationship. Fellas, if you know a lady, if you've known her for 5 years, y'all been cool, y'all hang out, y'all go get food, y'all go to these outings, and y'all could just be friends. Y'all go bowling, y'all go skiing, y'all do all of these cool things together. Let's say over a 5-year period. That 5th year, a shinier, newer, stronger, faster, taller you comes along and meets her, and now they have this great, it's like an explosion. Like they're, oh wow, she's infatuated with this guy, right? If there's an ultimatum presented 6 months after he's introduced and he tells her, hey, I need you to stop hanging out with that guy because you've been hanging out with him for how long and y'all are just friends and you can sacrifice that relationship, she's going to contemplate seriously leaving him, or she's going to contemplate her relationship with him because she's known you for 5 years. This is 5 years. That's 5 years of her life that she does not regret. Again, y'all could just be friends. Now, her and this new dude are not dating, right? But he's just a stronger, taller, faster, shinier you. He's just the new thing. So he gives her the ultimatum like, hey, I need you to stop hanging with old boy because I need all of your time. She's going to say, well, hold up. I don't know him. Wait. We can't. She's going to seriously reconsider the relationship that she and him had, right? Because you have that time in. So you don't even have to worry about that because she has a history with you to go off of. So she's thinking about year 2, month 4, day 17, when you know, and y'all was at the park and that the goose, the gang of meats, the goose came. It was a gang of meats. So the goose came and snatched the sandwich from you. Yeah, obviously he was hungry, so he went and grabbed that. Boom. And it was funny because you had been telling her all day how you had made that sandwich in a long time. You put all your right ingredients in there. The recipe was tight, whatever. You go to take a bite, boom, bird come in and take it away from you. She's going to remember those moments. It's the same thing with investing. If I trickle in, right? If I put a bucket underneath the faucet and I let it drip into the bucket, eventually that bucket is going to get full, right? Eventually that's what's going to happen. 5 years from now, if I just turn the water on high and I fill up the bucket, yeah, it's going to get full, right? But that's a 5-year-old bucket. It might have holes in it, cracks. See, if I'm dripping from that first point through that 5 years, I can inspect and I can see, okay, where are the cracks here in the bucket? It's getting a little heavy. Let me turn it this way so it doesn't spill over in the sink, right? And I'm not pouring money down the drain and it's not wasted. But see, when I rush and I put everything in at that time, I'm expecting results like that. But when I'm dripping into the bucket, I'm understanding that one day that bucket is going to get full. I can pick that bucket up, put it over here to the side. Hey, that's for the fam. That's y'all. Drink. Grab another bucket, put it under the sink, and drip some more. So and it becomes habit. You want good things to become habit, right? So as you're investing throughout the years, you're putting a little bit in here and there, boom, boom. You're not overwhelming yourself. You're putting that in, you're putting that in. Going back to the first point, you look up 5 years from now and you go, okay, well, I can pay my mortgage with my investments. I can pay my phone bill with my investments, my car note, my insurance. Man, you know what? Yeah, we're going to go ahead and make this the last month right here. This is going to be the last month of investing. So this is why it's important that you try not to predict the market because good companies are always going to exist. There's always going to be opportunity. And if one asset isn't working, you can go to another asset and they all trade on the stock market. So you got all the assets right there. So that's why it's important not to try to predict something, because you want to be a part of that group of people that's like, yep, I'm slowly investing and I'm in here and I'm patient and I can wait for wealth. See, wealth takes time, and that's the goal. The goal is wealth. So if you want it, you have to take your time to get it.
That's what's up. And Chris said something important. He said those good companies, quality companies, you don't look, if you're putting your money in those quality companies, right? You don't really have to wait, for the right time. Because those quality
Because
companies
it's
are gonna do
always the right
good.
time.
They're gonna, whatever storm that's going on, they're gonna work their way through.
They're gonna weather it.
So yes. Appreciate you, Grandmaster
Yeah,
Sensei.
man. Listen, and good companies always exist. Stop trying to find the next Apple, the next Tesla, the next Tesla and Apple already exist. Microsoft is already here. They're already, and put your money in them now, right? There is this there is this unfortunate narrative that, oh well, if I'm gonna invest in something, I want to get a whole piece of it at a time. I don't have time for specifically with stocks. I don't have time with fractional shares. Why? Who are you that you don't have time for fractional shares? Okay, so Tesla's trading at 225 right now, and every time you get paid, you're gonna put 225 in Tesla. You don't have to.
Right.
Stop. So what you're saying when you say that is the minute that you decide to invest in a whole share is the minute that it goes to $1 million. No, that's not what happens. You're not that good. Okay, they have people who have been who their life is investing that are not that good. Nobody's that good. So if AutoZone is trading at $1,700 a share and you want to get in AutoZone because you think, okay, when you done your research, it's a good company, and you definitely see it going to 2,000, you don't have to spend $1,700 on one share, because what's going to happen when you buy that share and it goes down to $1,675? Now you're going to be mad at yourself. Now you're going to want to sell the share. Now you're going to want to pull this. All right, I'm good. I just lost $25. This stock market thing ain't for me. No, so you're being hard-headed. Put a little bit in. $100 in, $100 in, $100 in, 100, and before you know it, you'll have one full share of AutoZone. If that's the one that you want to keep investing in, and you keep investing. Or you can do Apple the same way. Apple is trading at $150. You can buy $75 every week. And guess what? In 2 weeks, you'll have one. So that's 52 weeks out of a year. That's 26 shares of Apple in a year. Now, granted, Apple price is gonna go up. So it ain't gonna stay 150 for a year just for you to get 26 and then start trading. It's not gonna do that. Apple is going to continue to perform very well for a decade or two, right? Maybe even 3. And their spinoffs and their investments in future companies are gonna be great too. So they always gonna make money. Right. It's the same people, just different names, different products, different companies. So put that 75 in, then put another 75 in. And then if it goes up to 160, put that 80 in, and then 80, and keep going like that. You don't have to get a whole share of it, because you're working your way to wealth. Get rid of the ego. Get rid of that. Get rid of it. Tesla's trading at 225. I can only put 100 in. Put 100 in. Don't, I'm going to save up and wait till I get. Don't do that. Invest. If you have that money to invest it now. Don't wait. Invest it now. It's always the right time to get into the market. But if you're looking at the market now and you have the money to invest now, invest.
Invest it.
Just that simple.
All right, you all. It's time for stocks of the week. Yeah.
Yes, sir.
All right. So, my first one I'm going to mention is Apple. Look, this is October. November, December is coming up. And we mentioned this before. Ooh, that iPhone. Let's go and get that iPhone. Let's go and get it.
Gotta do it.
Gotta do it. And then you got people want to buy Apple products to be able to give to their, family members and stuff. Christmas. Yes,
Yeah.
Apple is my first one.
Yeah.
All right. Now, my second one. All right. We got where this is kind of like the health benefit season here. That's actually that's on the scene coming up. So I never actually mentioned this company before, but the name of this one is called the United Healthcare. This stock right here, right now, is up to like $513. It's been around for a while. Matter of fact, it's one of the main stocks is actually in the Dow. Actually, check out the performance, and it's going to be kind of banging for this particular it's been banging over the years each year, but it's going to be kind of banging a little bit more because of people getting benefits, especially older people actually getting benefits for this time right here. So definitely want to check that one out. And a ticker for that is UNH. It's the ticker for that, United Healthcare. Don't sleep on it. My last one, this is an ETF, XLY.
Hey man, you took mine, man. I was gonna surprise y'all today.
Oh snap! Oh snap! I did not.
You good? I got another Excel I'm gonna present. Dang man, okay, all right. Great minds think alike. All right. Go ahead, Sensei.
I did not know. Oh my goodness! Oh my goodness. Look, you got all the consumer stocks in that one right there coming up. Look, they're all in that ETF. No, it's not. Take advantage.
Man, I just scratched my notes out, man. Okay.
Oh
all right.
no, man, you can still.
No, you good. You good. That's definitely mine. I'm gonna go ahead and put a clutch 4 in there with another Excel. But we good.
Okay. All right.
Yeah.
Those are my 3: Apple, United Healthcare, and XLY. Chris, what you got, man?
XLY. I'm gonna go there too. You good. Man, I'm like, yo, he just I'm looking for cameras. So Walmart, obviously. Okay, Walmart to the end of we good. Walmart. I keep saying it because I mean it. To the end of the year, it's that season. Target, same thing. End of the year, it's that season. It's the wave. Retail. We going in. Holiday season coming up. These companies are gonna make money. You gotta make the money back from the loss from the beginning of the year, and they've been up the whole year. So these are retail giants. Everywhere you go, it's a Walmart. Everywhere you go, it's a Target. They got everything in there. If you want to sell something, you want to put it in Walmart, right? You want to put it in Target. So these two companies right here, great investments for a very long time. The online space they're getting in, the small business space they're getting in, because Walmart and Target are great because they're distribution platforms. That's all that they are. They're just housing units for people's products. That's it. Walmart is the Apple of retail. If you want to sell an app in the App Store, you got to pay Apple 30%. Apple never has to all they got to do is keep that stronghold in the market, keep the App Store user-friendly, continue to make the interface better, change from what they used to do to what they do to back to what they used to do. They just got to switch back and forth. In fashion, they say it makes a rotation. So the 80s is in style now with fashion, and then in the 2030s, the 70s will be, and then in the 2040s, we'll go back to the 20s. So you're just recycling to make people feel like, oh, okay, it's something new, right? You'll add a couple new technological advances, but that, that's a little bit of hard work, right? But if a company is not innovative, they will fail. You have to be innovative, and you have to hire good teams that are going to push the company forward by taking chances. You have to allow them to do that. XLI is my ETF for this week. That is the industrials ETF. I put that in there. XLI for me is like a 10, 15. That's like one of the long holds, because we're moving into, so 3D printing has not taken off like it will, but be prepared for that. John Deere and Caterpillar obviously are in that, the XLI. I believe UPS is in there. It's an industrials logistics ETF. Things are always going to move. Things are always going to be distributed. Things are always going to be created. Things are always going to be invented. So XLI and I'm talking about like seeing a profit. The dividends are great, but I'm talking about, this is something where you can set it and forget it. You can put money in and never look in that direction, because it's the slow growth. Over the past 5 years, XLI has grown 80%. So average about 20 a year, which is fantastic. I mean, you can't ask for better. It's not going to get you, technology growth, 1,000%, 600%. It's not going to get you that, but it's that constant growth. It's, okay, well, we're up 7% this year. We might be up 2% next year. We might be up 14% the next, then 1 the next, then 10 for the next 3. But it's that slow growth, right? What E40 say is that slow nickel, because 20 years from now, after having 20 years of invested in XLI, the returns are going to be great. The dividend is going to be great. And you keep reinvesting and putting your money back into it, man, you're talking thousands of shares, right? You're talking thousands of shares of equity. So Walmart, Target, XLI, and for healthcare, what Leroy was mentioning earlier. So we are moving into the age of mass retirement. This is why you see a lot of people from the northern region of the country move to the south, the Northeast, the Midwest, and the Northwest, because something like 20 million baby boomers are going to retire over the next 10 years. They don't want to retire in the cold under snow with no sunlight. So they're going to retire down here where the weather is, and the bikinis just keep getting shorter and shorter. So they want, old men like the same thing young men like. It's just, we got to keep it real. But what you're seeing is a retirement tsunami, because simply obviously because they've aged out of working. But what you're seeing is a retirement tsunami over the next few years. So anybody starting a business, you want to start a healthcare business? You want to just open up a house and house the elderly in a house and have a medical team on staff and have a cleaning team on staff? You offer them amenities, man. And don't even call it a senior living facility. Just get a castle. Just buy a house with 7 or 8 rooms. Just rent out each of those rooms. You have a medical staff available. You have a doctor available, and you just let them live their life. You have a chauffeur that takes them places, and you charge them each how much ever a month. You provide them those services, and you'll be set. So healthcare is not only a great investment for now, it's a great investment 10, 20 years from now, because it's about to be a lot more retired men and women in society. I'm talking about like old people with nothing but time on their hands. That's it. And so they love their doctors. They doctors give them all kind of pills. So that healthcare is not going anywhere. It's a great investment. The Walmart, Target, XLI.
All right, you all. That's it. Like, subscribe, comment, and share. We out. CoWaCo.
Next time. See y'all next time.